Autozone is a retailer and distributor of automotive replacement parts and accessories in the US, Mexico, and they have a tiny footprint in Brazil. The industry is highly fragmented, mature, and driven by the number of vehicles in use, the number of miles driven per vehicle, and the average age of vehicles, which management identifies as the most important metric for their business. And this has been a tailwind over the past decade, with the average age of vehicles increasing from 10.3 in 2008 up to 12.5 in 2023. They operate in two primary lines of business. The first is the do-it-yourself or retail segment, which makes up about 70% of sales. And although they do not perform repairs or major installations, their customer service and superior product availability are cornerstones of their value proposition to their customers. Their staff is trained and more than willing to help you diagnose a problem and install a part that you just bought from them if they have the skills to do so. In fact, they have a program called the Loan a Tool program, where customers can literally borrow a specialty tool for free because AutoZone recognizes there are some instances where a customer just needs to use this specialty tool one time, and rather than making them pay for it, they just let them use it and the customer returns it all for free. Now, if that isn't great customer loyalty and service, I don't know what is. And I can't recall how many times I've talked to people who prefer to go to AutoZone because of the customer service that they offer. All of this allows AutoZone to charge higher prices than their competitors because their customers see value in the additional help that they can get from the staff. The second line of business that they operate in is the commercial or business-to-business segment in the US, which is much smaller and makes up about 30% of the sales. This segment provides commercial credit and delivery of parts and other products to local, regional, and national repair garages, dealers, and service stations. In addition to being able to charge higher prices, AutoZone's size and scale enables them to work out extremely favorable volume and payable terms with their suppliers. In fact, their average payables to inventory ratio is sitting at 1.2 over the last 10 years, which means that AutoZone is able to sell its inventory before paying for it, thereby avoiding the upfront capital costs associated with holding physical inventory. This, along with volume-based discounts, gives AutoZone a significant cost advantage over its smaller competitors, and along with higher prices that it can charge due to its great customer service, results in the high and rising margins that you'll see later on. That's the general overview of the company's operations. Let's go ahead and take a look at their financials on a high-level basis to see whether or not it's worth our time to dig into further. Margins are better than I expected given their physical store load and massive inventory requirements. They have a lot more debt than cash, which in my opinion is not a good sign, and it makes me immediately wonder how high their debt to equity ratio is. The free cash flow yield is sitting at 4%, which suggests that this stock is not that expensive. On a price to earnings and price to sales ratio, the valuation is not that bad at all, but on a price to book ratio, it's rather high, due most likely to the heavy debt load. Let's take a look at how the stock has performed over the last 10 years. It's just a nice, steady, not too volatile march upwards. Revenue is steady and predictable, but growing a little slower than I'd like, but has accelerated to the 7 to 9% range over the last 5 years. Free cash flow is also growing slower than I'd like in that 7 to 8% range and has actually declined over the past 2 years, which is not a good sign. Their stock-based comp is not a problem whatsoever. And on a per share basis, the free cash flow is great. It's still declining over the last 2 years, which is definitely a red flag. But we're past that 10% threshold that I like to see over the past 5 to 10 years. The fact that their per share metrics is significantly higher than the absolute free cash flow dollars suggests that they buy back a lot of their stock. Earnings per share is beautiful. Debt is steadily climbing over the last 25 years, which again, in my opinion, is not a good sign. Because if the Fed keeps interest rates higher for the next several years, many companies will have to refi at much higher rates, which will negatively impact their earnings. In my opinion, this is a pretty big risk, and we'll have to look at the debt schedule once we dig through the annual report. They don't pay a dividend, which I don't like to see. I generally want to get paid to hold the stock. It's a ding against the stock, but not a deal breaker. Now let's take a look at the shares outstanding. It all makes sense why their absolute metrics are growing in the mid-single digits while their per share metrics are growing up in the 10 to 15% range. They're buying back 6% of their shares outstanding every single year. This is massive and probably one of the biggest buyback rates that I've seen in any stock I've analyzed. This is also the likely reason that they've taken on so much debt, but that still needs to be verified. Their return on capital employed is amazing. I was not expecting an auto parts store to be posting consistent 40 to 50% return on capital employed. Margins are consistently expanding over the past 30 years. Given that they have a large physical store load and carry tons of inventory, the fact that they are constantly expanding margins suggests that they have a cost advantage due to their distribution network efficiency. And this is a great thing to see. So that's it for the high-level analysis, and for the most part, I like what I see with AutoZone, with only one red flag, and that is their debt load. Let's continue on the analysis with a deep dive into their financials, and for this, I use Schwab.com. Let's start off with the income statement. Revenues are up about $5 billion over the past 5 years, and as you can see, it has been a smooth, predictable ride. Given that they operate in an industry where their products tend to be time-sensitive and vital to operating a vehicle, there is very little variability in their sales, even during economic downturns. When I'm analyzing any retail business, I want to take a look at store growth and same-store sales numbers. As far as store growth goes, they're growing their store base at about 2.5% to 3% per year, while only closing 3 stores over the past 5 years. That's incredible. Same-store sales are performing well too. Incredibly, AutoZone operates exclusively in the United States and Mexico and has a tiny, immaterial footprint in Brazil, which means that if they choose to, there is significant opportunity to expand globally in the future. Operating expenses are up about $4 billion over the last 5 years. Pair that with revenues increasing by about $5 billion, and that's driving up operating income by about 50% over the last 5 years. AutoZone has a very simple income statement. The cost of revenue is the largest expense due to the business being a physical goods business and has driven the majority of the cost increase over the past 5 years. Selling, general, and administrative expenses is the second largest component and consists of rents or leases on the building, staff salaries, etc. I gotta say, I'm surprised at how little advertising they do. They're able to deliver impressive free cash flow growth and expanding margins without much advertising. Another thing that points towards a strong competitive advantage in their industry. Let's jump over to the balance sheet now. Assets have increased by about $6 billion, driven primarily by inventory and property, plant, and equipment. On the liability side, it's a story of debt, debt, and more debt, with liabilities growing by about $9 billion. This is not a good sign for the growth of their equity. Accounts payable and accrued expenses are growing rather quickly, and debt is up 50% over the past 5 years. These other liabilities are lease liabilities and are offset by a corresponding asset in the asset side, so there's no material impact from that. And holy crap, they have significantly negative equity and retained earnings, and it's getting about $1 billion worse every single year. We're going to have to jump over to the annual report to figure out what's going on. It's most likely the debt that they're using to buy back such a large percent of their stock, but we need to verify. So what you're looking at here is the consolidated statement of stockholders' equity. It basically walks you through all the moving parts that make up stockholders' equity. As you can see, we had already started with an equity deficit in 2020, but the story is pretty straightforward. We're bringing in $2 billion in 2020, but then we're buying back $3.4 billion in common stock. In 2021, we're bringing in $2.4 billion in net income, buying back $4.4 billion in stock. And we continue that trend in 2022 with net income of $2.5 billion, while we buy back $3.7 billion in common stock. As you can see here, we are buying back more stock than we're earning, and we're using debt to fill the gap. And so every single year, our equity gets more and more and more negative. Not something that I generally like to see. In a nutshell, they're using their earnings and accounts payable to fund their inventory cycle and to buy new property, plant, and equipment, while taking on excess debt and plowing every penny they can into share buybacks. This is the overwhelming driver of their amazing earnings per share growth over the past 30 years. It's true that their net income is growing nicely at about 10% per year, so there is a great, profitable company underneath. But then you add on an average buyback of 6% of outstanding shares every year, and that has catapulted their earnings per share growth up to 17% per year over the last 10 years. Earnings per share growth has been shown to be the primary driver of a stock's price. Looking back at the stock price chart, AutoZone is up 38,000% since 1991. That's not a typo or a misquote. This stock is literally up 38,000% over the past 33 years. Compare that to the S&P 500 gain of 1,500%, which is still amazing, but it ain't no 38,000%. And look at this. The stock price did just fine from 1991 to 2000 when it quadrupled, going from $7 a share up to $30, driven mainly by organic earnings growth. They weren't doing the same level of buybacks that they have been since 2000. In fact, the share count was increasing during this period, and the stock still did very well. This again points to the fact that there is a strongly profitable underlying company with a strong competitive advantage. But starting around the year 2000, you see a lift off in the start of this 38,000% rocket ship, right as they started plowing all of their earnings and taking on debt to fund these crazy amounts of buybacks. So those are all the benefits of this strategy, but let's consider some of the risks of this type of strategy. First, taking on debt makes a firm's cash flow look better than it actually is because debt is an inflow into the cash account on the cash flow statement. Autozone relies heavily on its vendor relationships to allow them to hold huge amounts of accounts payable, but if the vendors start demanding stricter payment terms on their contracts, it could cause earnings and cash flow to drop and the share price would likely follow suit. They could also experience increasing interest expense first because of the increasing debt load, but more importantly due to higher interest rates. This would also dent their earnings and cash flow and would most likely reduce their stock price as well. Lastly, there has been repeated calls by politicians to limit, tax, or even outright ban share buybacks. Imagine what would happen to the stock if buybacks were banned. I honestly doubt that would ever happen, but there could be a tax levied on buybacks, which would increase the cost of doing buybacks and deter AutoZone from buying back so much of its stock, which would have a negative effect on its stock price. Okay, let's take a look at their cash flows. Operating cash flow is driven by net income, which is what I would expect. Investment activities are very basic, with capital expenditures, which are running about 4 to 5% of sales, and the purchase of investments being the main consumers of cash in this section. And then we get to financing activities, where we can see how the share buybacks are financed. They're taking on an average of $1 billion of new debt each year, combined with organic earnings and a buildup of their accounts payable to finance their stock repurchases. All in all, their financials are strong with the exception of the increasing debt load and negative equity. To be honest, it makes me a little nervous about owning this stock. Let's take a look at how they stack up versus their competition. The first thing that sticks out to me is how low the daily volume is on all these auto parts, especially AutoZone at only 200,000 shares traded per day on average. Compare that to Meta, which trades an average of 12 million shares a day, Google 17 million, and even PayPal averages 8 million shares traded per day. There's definitely some liquidity concerns here with all these auto part stocks, but more so for AutoZone. Their profit margins are good compared to their competition, but we can't calculate the capital efficiency metrics because of their negative equity. They're middle of the pack in terms of earnings, sales, and cash flow valuation. They're slightly cheaper than their main competitor, O'Reilly. In terms of growth rates, they're growing faster than their competitors. Neither they or O'Reilly pay a dividend, and they're just as profitable as O'Reilly and much more profitable than the smaller competitors. All in all, they're better than the small competitors and about the same as O'Reilly. As we stand right now, this is a company I'm very interested in, but the risks related to their long-term debt load, their ballooning accounts payable, the potential for regulations around future buybacks, and the move towards electrical vehicles has me a little nervous, but not nervous enough to push this stock to the side. The last thing we need to do is to determine a fair value for this company. To do this, I look at Morningstar's fair value estimate, which comes in at $2,550 per share, and CFRA's fair value calculation comes in at $1,870 per share. Lastly, I run my own discounted cash flow model, which comes in at $3,398. Because of the risks that I outlined in this video, I want to have a larger margin of safety than I would with a Microsoft, a Visa, or other highly profitable, yet more conventionally managed company. So I'm going to use a 30% margin of safety, which means I'd only be willing to pay $2,379 for this stock. That's a 15% drop from where it currently trades, which means that I'll have to put it on my watch list and wait patiently until it drops. Well, that's it for this deep dive. Let me know what you think about AutoZone in the comments below. Also, please leave a comment about any other stocks you'd like me to analyze in the future, and I'll do my best to get around to it.